Hello everyone. Thanks for joining us on this Charity Finance Update webinar. We'll be taking you through some recent developments on topical financial issues affecting the charity sector. Just a bit of an introduction to your presenters today. I am Rob Frost. I am a director at based in our technical standards group. I have a particular specialism in charity accounting and reporting. I will be joined by Fiona Condren, a partner in our specialist charity team here at BDO. We'll be doing a bit of a double act for you on some of the topics. So just a bit of a topic listing for you. We will be covering some financial reporting and auditing matters. Don't let the auditing bit put you off. There would definitely be some relevance to you as a charitable organisation. As part of that, we will introduce some recent developments, do a bit of looking forward, and then think about the implications for any upcoming audits that you might be focused on. Then Fiona will take over from me to talk about the governance code and pick up on some matters relating to reporting serious incidents and whistleblowing. So to kick us off, we'll start with a financial reporting and auditing update and begin with the SORP information sheet, which was released earlier in 2017. A few things just to note about this information sheet. It's technically not mandated by any law or regulation. It is effectively implementation information in relation to how the SORP is expected to be applied. Quite a few things featured in that information sheet, which is available from or via Charity Commission website or via the SORP microsite. The main changes really coming through in the charity SORP information sheet was in relation to cash flow statements, just clarifying that in relation to individual accounts in a group sort of environment, individual entities could claim cash flow exemption provided that the consolidated cash flow was prepared for the overall group. Also some information given in that information sheet about cash flow requirements for certain size limits. Other things worthy of pulling out from this particular slide are comparative figures, just to really re-emphasise the point that comparative figures for all material items in a set of accounts in theory are required. For a charity's account, that will include fund disclosures and related disclosure analysis notes. Common omission noted within a set of charities' accounts are disclosures that relate to items like fund analysis, and those disclosures of comparatives are also required. Talk to your advisors about that if you think that the disclosure of retrospective or comparative information looks a bit unwieldy, and there are a few options out there in terms of how that information might be presented. Other things worthy of pulling out here, just to make sure that the point is really clear. The SORP information sheet does clarify about treatment of funding for being clawed back by funders. Just to really emphasise that there's a couple of points to consider there. Is it the case that you should never have recognised income because you didn't meet the entitlement criteria? Really just reminding preparers that must result in a prior year adjustment. Whereas if it is the situation in which a charity believes they are actually entitled to income, but then some condition has changed, which means that they become no longer entitled, that is a prospective application. Again, if clawback is of issue in the organisation that you represent, speak to your advisors about potential impact coming through in the information sheet. The point about exemptions from disclosure of names of related parties, that sounds more exciting than it is in some respects. The main point being there that names do need to be given unless it would be kind of seriously prejudicial to do so, and that really means the name of the person affected would be effectively in danger from having their name disclosed in a set of accounts. So the exemption is expected to be very rare, and the information sheet clarifies on that. A couple of other points, really, just to draw out the information sheet. Won't go through all of them, but a couple of other points to pull out. The inclusion of employers' national insurance contribution whenever you talk about employee benefits, particularly in relation to kind of key management personnel disclosure. the requirement to have a fair value reserve, particularly where you are dealing with a charitable company, and the information sheet clarifies that where the charity is not a company, then such a fair value reserve is not required. Then just a clarification about the definition of a larger charity. It used to be aligned to the auditing threshold of 1 million, but larger charity has now been redefined, if you like, as being 500,000, income greater than 500,000. So that's a point worthy of noting. Wherever you read in the SORP auditable charity or larger charity, you read that in conjunction with the income threshold of 500,000, even though the audit threshold is now at 1 million. As a very, very quick canter through of the SORP information sheet, if people aren't familiar with that information sheet, it is one well worth jumping onto that microsite and having a read of. It's in a fairly digestible fashion, and as I say, is really helpful in interpreting some of the more vague requirements of some SORP areas. On this slide that I've just moved us onto here, it's just worth noting, I've put it down at the bottom there, SORP information sheets. I think just to say that we can potentially expect more information sheets over the passage of time because the SORP Working Committee and the regulators have found that issue of information sheets as a useful way of getting some points of clarification out there whilst not changing any requirements. So do keep an eye out for that and monitor that SORP microsite from time to time because useful information does appear on there. I thought it was worth giving a quick update on developments in charity accounting. That information sheet is a bit retrospective looking. Let's look forward for a minute or two. And just really picking up on the SORP research exercise from last year, many of you will have responded to that research exercise. Some of you will have noted its content, but will anxiously and eagerly awaiting the outcomes of that exercise. It's really just to give a quick update that I think that the SORP Working Committee, there's a few things that they are focusing on as a consequence of that research exercise. It's likely they will be exploring the possibility of a third tier of framework in the charity domain, being that for larger charities. It remains to be seen whether that third tier will be created by the layering on of additional requirements for those exceptionally large charities, or whether it will result from taking away some existing requirements and creating like a smaller framework for the very small charities. Difficult to know for certain which way that will go. It's hard to see what could be taken out legitimately from the SORP that wouldn't be resulting from an underlying requirement. But that's a potential that they are exploring or will be an interesting development. I think it's fair to say that any larger charity framework would be looking more towards those charities which qualify, or I should say don't qualify as small under the Companies Act threshold. So really kind of 10.2 million turnover, 5 million or 5.1 million balance sheet totals, staff of 50. Anything over those sorts of thresholds, we might be talking larger charity in the future. Nothing concrete on that yet, though, so it's a watch this space on that point. Definitely coming out of that research exercise is more of a focus on the narrative. We can expect some sort of exercise being conducted by SORP Working Committee on the trustees' report content, particularly around perhaps more transparent disclosures, maybe in relation to remuneration, a bit of looking at the governance type requirements in there, the how and whether charity voluntarily complies with good governance codes. That sort of information might be a factor featured in trustees' reports in the future, but definitely narrative a target of SORP Working Committee attention. Other initiatives, things like coming out of that SORP research exercise, things like key facts summaries, we know is of particular interest to the regulators. It will be interesting to see how any key fact summary is mandated in terms of content and whether that shifts focus, if you like, of preparers of accounts on some of those numbers that might appear in a key fact summary. Some talk about the requirement there will be a requirement to produce a key fact summary, but its content may largely be fluid and flexible in terms of what might be the right content for a charity to include. But again, it's another one of watch this space on that one. SORP update bulletins, I've mentioned this here because many of you will be aware of recent developments in Financial Reporting Standard 102, the underlying accounting standard on which the SORP is based. There are a couple of exposure drafts, which is what the threads are there alluding to, financial reporting exposure drafts 67 and 68, which are proposing to change the underlying accounting framework. And the SORP, if it is to reflect the underlying accounting framework, should in theory be updated to reflect those changes. The SORP Working Committee are likely at this stage to not reissue a new SORP as a consequence of these changes to the underlying framework, but instead are likely to deal with any changes that come through those exposure drafts as part of a bulletin they might issue in future, which will effectively form part of the SORP. You would have to read the SORP in conjunction with any bulletins that have been issued. So worthy of noting that there, I will mention a bit more about 67 and 68 in a moment. And as I said at the beginning, SORP information sheets, we might expect more of those in the future. So just to pick up on thread 67 and just thinking about what the main changes affecting the charity sector were in 67, 67 was not really a fundamental overhaul of FRS 102, just really picking up on a few of the major gripes and bugbears coming through in that accounting standard. The main changes affecting the charity domain, and I say there are a few, but the main changes really relate to the removal of broad cost and benefit exemptions. Some of you will be familiar with the fact that under FRS 102, there are some areas of the standard which say you must do X, Y, and Z unless the cost of doing so outweighs the benefit provided to the users of the financial statements. I think there is a bit of a perception that some of those cost-benefit exemptions have been abused in practice, not by charities necessarily, but by the preparers as a whole, and therefore those cost-benefit exemptions have been removed, and instead they will be replaced with specific exemptions, so you effectively have accounting policy choices rather than it being based on a cost-benefit type arrangement. So, for example, under FRS 102 at the moment, you must fair value investment property, even if that is investment property that arises in a group environment, and unless the cost of doing so outweighs the benefit. Going forward, there will be a specific exemption that just says you have a policy choice there. You either fair value or you carry them at cost. What it does mean is that the idea of a cost-benefit exemption being taken where there is no specific allowance to do so will be removed, and that was what the main features were likely to want to achieve. Coming much further forward on the horizon, we have IFRS 9, 15 and 16 in the international domain. Hopefully most of you are aware that charities cannot follow IFRS, so on the face of it, these changes don't seem particularly relevant at first glance. However, we do know that FRS 102 and the UK standard setters intend to take their cues for future development from the international standards. That means the triennial in 2022 that could well factor in some of these changes coming through in IFRS 9, 15 and 16. Interesting points to draw out from those three standards. I won't go into too much detail on this presentation, but interesting points to note are the potential for a requirement to include all leases on the balance sheet. That would include operating leases. So even those where you don't believe you retain all or the significant proportion of risks and rewards, under IFRS 16, an entity would have to report leases on their balance sheet. That could have a significant implication for a charity that does have a significant leasing asset in its portfolio. IFRS 16, the standard on revenue, is another interesting one which really captures the concept that we are actually quite familiar with in a charity environment of recognising revenue to the extent that performance obligations have been met. What I do think is interesting about IFRS 15 in particular is its kind of similarity to the revenue recognition criteria applied in a charity environment, and it's interesting to see international standards, if you like, aligning much more with what we do in our sector here in the UK. But IFRS 15 is quite a complex standard with a lot more changes associated with it in terms of looking at specific contracts. And that could well in the future have implication for charity reporting. Just a couple of things on FRED 68, which is of particular interest in the charity domain because FRED 68 is a standard specifically targeted at the not-for-profit or public benefit entity environment. FRED 68 aims to deal with the question about how do we account for gift aid payments from a subsidiary to its parent charity. And this really reflects the ongoing debate about, or two things. One being, can you accrue for a gift aid payment, knowing that it will not be paid until after the year end, but that you actually have every intention of making that gift aid payment. And the other question being about whether it should be above or below the line. Should it be presented as an expense or should it be presented as a distribution, as is the legal position as reflected in the ICAW's guidance on this point. Interesting that the FRC have decided to take this matter on and actually reflect a change in the standard, the underlying standard, to deal with this issue. What they propose is that it will not be possible to accrue for a gift aid payment unless there is a demonstrable commitment to that gift aid payment by the year end. And FRS 102 at the moment, at least, the proposal is that it will say that a deed of covenant is necessary to demonstrate that commitment. What that will mean is you cannot accrue the gift aid payment at the balance sheet date, so in theory you will show a taxable profit in theory at that point in time. Unless a deed of covenant has been put in place. Any taxable profit, though, the proposal affecting the standard, and this is the main crux of FRED 68, the proposal is that you just would not recognise the tax charge on that taxable profit if it is probable that you will make that gift aid payment after the year end. So really dealing with I would argue the main accounting issue really that results from this gift aid debate and question, which is, well, why should I recognise a tax charge when I know I will never pay it type argument. So that's really what FRED 68 proposes. The solution isn't really without its problems because it does present a view of the accounts that shows a profit generated, which or a user should be made aware that it will not ever retain in its entirety, either because it will distribute the whole lot to its parent or because some of it will have to be paid out in tax. And neither of those two kind of outcomes is reflected based on the FRC's current proposal. It will therefore mean that there would have to be some quite clear disclosure at the back end of the accounts about the implications of this. So a solution not without its problems, and the solution in practice has not actually been incredibly popular. There has still been quite a few vocal opinions expressed that we should be trying to find a way to maintain status quo, i.e. to allow for subsidiaries of charities to continue to accrue for that gift aid payment. Unfortunately, at the precise moment, I say unfortunately for those that wanted that outcome, that isn't quite where the FRC is in their proposed solution. That has just been consulted upon though, so there could be further changes proposed in the future. Now, Audit and Practice Note 11, I don't intend to say too much about this. It's just really to make you aware that auditing standards for charities has changed, and that's because the underlying ISAs, the International Standards on Auditing, have been updated recently for periods commencing 17th of January 2016, so effectively any June 17 year-end onwards. That means that Practice Note 11, the practice note issued by the Financial Reporting Council, which interprets auditing standards for application to the audit of charities, that is also about to be updated. The main things to note there is that we do anticipate probably 4 key changes coming through, one being the format of audit reports. You can expect a significantly different presentation of audit opinions in the future. The other changes being some additional responsibilities for auditors when they look at the more narrative aspects of your accounts, so the disclosure notes and the bit that normally represents the trustees' report. Now, in the past, It may have been that the auditor had some flexibility, or at least one interpretation is the auditor had some flexibility in terms of the extent of work being performed on that narrative surround information. Going forward, the auditor will have increased responsibilities to make sure that anything that looks unusual or inconsistent or a little bit odd, shall we say, in the front end in particular, would need to be challenged and followed up directly with the preparers. And in terms of the back end, the disclosure notes, the auditor really does have responsibilities to be considering disclosure when they reach their true and fair view opinion. So it's really just to highlight the fact to users, and there are a couple of things on the slide there about particular things that Practice Note 11 will pick up on, but it is really to highlight to preparers of accounts that auditors do have additional responsibilities in relation to a lot of the narrative and its surround information in your accounts. And to that end, that means that your auditor, and you can expect your auditor to be asking you more questions about that, to be challenging you on certain aspects, to be asking you for more evidence and information that might result. So don't be surprised about that fact, and if it feels like there's a lot more attention on it, then that's because the auditor is required to do so. If any of the other bits and pieces of information on that slide there are of interest to you, then again, do get in touch with your auditor because they will be able to explain more details for you. Now, just very quickly in relation to independent examinations, just to make you aware that a new CC32, the Charity Commission Guidance Note on Independent Examinations, has been released for England and Wales. That was updated in September 2017. It really just updates a lot of it for the income criteria for independent examination. So now you can have an independent examination if your income is less than 1 million, but just updating a lot of the details for that. It's effective for reports signed from the 1st of December, so we have a little bit of time left before that becomes kind of mandated. 5 areas of significant change, though. The directions themselves, there are 3 new directions that have been added, principally around conflict of interest, but I'll pick up on that very briefly in a second. There's more detailed guidance for each direction. There's a new format for the independent examiner's report. It's been updated for matters of material significance, which is a point Fiona will come on to in a moment. And there is new guidance on the reporting of relevant matters. There's also been little tweaks here and there for certain other hot topics in the past, such as, for example, on mentioning group audits and what you do on an independent examination of a set of group accounts. So again, if you are independently examined, or more correctly, I should say, if you are subject to an independent examination, you can expect some changes in the way that will be tackled. And there on your screen there is just some details about the additional 3 new directions. So that's it from me in terms of a financial reporting update. I'm going to hand over now to Fiona Condren to talk you through governance code and reporting matters of material significance. Thank you for your time today.
So thanks, Rob. So there are 2 areas I'm going to be covering, and the first is the new Charity Governance Code. So this was published this summer and is the 3rd edition of a voluntary code for the sector. I say voluntary as it's not a legal requirement, but is pretty close, and I'll come on to explain more about the apply or explain principles. But the background to the need for a new governance code was really a recognition and reflection that all charities now need to raise the bar in terms of the public perception of good governance in response to many of the specific challenges that the sector has faced over the past couple of years. So a strong recommendation from me is that if you've not already done so, please do go and download a copy of the code and propose that your board puts it on their agenda for closer scrutiny and consideration. So whilst not strictly speaking mandatory, the Charity Commission have endorsed the code and they've withdrawn their own good governance guide, which was previously set out in CC10. And we do anticipate that aspects of the new code will feature more prominently in new areas of guidance that the Charity Commission publish in the future. The code applies to registered charities in England and Wales, but there's absolutely no reason why the principles and recommendations wouldn't apply in other jurisdictions and universally to charities with diverse activities. For non-charities, for example, social enterprises, membership bodies, Those that are not yet registered as charities may well also like to adopt it. And whilst the same principles apply to large and small charities, there are more tailored recommendations which might be more appropriate for smaller charities to apply. The code is designed as a tool to support continuous improvement, and charity boards that use the code effectively will regularly revisit and reflect on the principles. It's very clear that this is about apply or explain rather than comply and explain, as it's recommended practice and not a regulatory requirement. So I've set out here a quote from the Charity Commission stating that the code should be a standard of practice that all charities aspire to. And importantly, they're encouraging charities, if they sign up to the code, to go public about it on their website or in their annual report. So because this isn't a compliance document, you will need to put some thought into how it might apply to your organisation. Trustees will need to take a look and identify where they're not quite there in terms of adhering to the recommendations, perhaps where they don't want to be and there may well be valid reasons, and where it might not just be relevant. It's not simply going to be a case of ticking a checklist, seeing where the gaps are and plugging them. The application of the principles and recommendations is not simply a way of avoiding bad things happening, rather it's about attitude and culture and whether at its core a charity really does put its values into practice. So, as shown on the initial infographic, there are 7 principles, and overlaying these principles is a foundation principle that trustees understand their legal duties and are committed to their cause and to good governance. It should be fairly self-evident why these are the key principles, and many of them you will already recognise as the key drivers of public trust and confidence in charities. And these principles of good governance are very much aligned with other existing codes, for example, for public companies, housing associations or universities, where there is in fact a financial consequence of non-compliance. I'm going to come back to the impact on the annual report and disclosures from principles 4 to 7 in a moment, but I just wanted to reflect on the first 3 principles. Organisational purpose. This means that the board is clear about their organisational purpose of the charity. It's being delivered effectively and sustainably. So this means charities need to have clear strategic plans, use their resources to deliver public benefit and have sufficient reserves by which to do so. Leadership. This is about having a focus on the charity being headed by an effective board providing strategic leadership in line with the charity's aims and values. And integrity, this is about being aware of the importance of public trust and confidence in charities and ensuring that the board acts with integrity and honesty with all the decisions that it makes. Furthermore, the board should act in the best interest of the charity and its beneficiaries, and they shouldn't be unduly influenced by those who may have special interests. So thinking about what we expect to see developing in the next reporting period, I wanted to reflect on a few key things. The application of the governance code will increasingly lead to some kind of brief statement explaining the use of the code in the annual report. If the charity already has their own specific sector governance code, then they should already be referring to that code that they're following. The implied requirement from the code is that there would be some kind of broader governance statement incorporating a description of the overview of the processes by which an organisation is directed, aimed at stakeholders and members, and it implies that everyone should know how the charity is being run. Decision-making, risk and control. This is about ensuring that the decision-making processes are informed, rigorous and timely, and there is effective delegation and control, and risk assessments and management systems are set up and monitored. So this implies that the board will adequately describe the charity's approach to risk in the annual report, which is very much in line with the current regulatory requirements set out in the SORP, whereby charities need to articulate principal risks and uncertainties and the plans and strategies they have in place to manage them. Board effectiveness is about having the right skills, experience, time available to commit to the role of trustee and knowledge on the board, as well as how board rotation takes place. Board diversity. This is about the board's approach to diversity in its widest possible sense. It's not just about the 9 protected characteristics of the Equality Act. For example, in supporting its effectiveness, leadership and decision-making, boards whose trustees have different backgrounds and experience are far more likely to encourage debate and make better decisions. So actively recruiting people who think differently really is important. And finally, in terms of openness and accountability, the board should set the tone here, and unless there is good reason not to be, they should be considering things that they should be saying rather than what they only want to say. Even if things are negative, it has to be better than the Daily Mail picking up the story and making something much bigger of it. So, for example, trustees will want to consider publishing the process for setting remuneration of senior staff and their remuneration levels very much in line with the guidance already set out by NCVO. And this links very much back to what we said up front about charities making a statement in the annual report about how the code is applied as an indication of openness and accountability. So moving on to my second topic this morning, which is serious incident reporting and whistleblowing. The serious incident reporting guidance was originally published in 2014 but was updated in September. There has long been a recognition from the regulators that the volume of incidents happening is probably much higher than the level of reporting it's been receiving. And although this is called guidance, the Charity Commission is clear that they absolutely require charities to report serious incidents and to go as far as to say that if in doubt about a matter, you ought to report it, you should report it. They do absolutely recognise that serious incidents do occur, often due to the challenging nature of work and the difficult context faced by many charities. And therefore, by reporting those matters, you can demonstrate that you've identified a risk, that the trustees are taking appropriate action to deal with it. With this information, the Charity Commission can also better assess the risk that other charities may face. So in summary, a serious incident is an adverse event, whether actual or alleged, which results in or risks significant loss of charity's money or assets, damage to property or harm to your charity's work, beneficiaries or reputation. And remember, when we talk about assets, we're talking about intangible assets as well as tangible assets. So this could well include things like data, donor information or other IP. So in the context of that, the most common types of incidents are noted on this slide, and they include fraud, theft and other losses, a large donation for an unrecognised source, links to terrorism, disqualified person acting as a trustee, inadequate safeguarding policies, not having vetting procedures in place, and suspicions, allegations or instances of abuse of vulnerable beneficiaries. Any criminal activity within or involving your charity is by definition a serious incident. Therefore, if your charity is being investigated by the police or another regulator, you do need to report it. And please remember that if you've reported a matter to the police, the National Crime Agency, Ofsted, CQC or any other body, you still have to report the matter to the regulator, the Charity Commission. It's also worth reflecting on the fact that the responsibility for reporting serious incidents rests with the trustees. In practice, however, it may be delegated to you, Finance Director, but trustees do hold ultimate responsibility for ensuring that the charity makes the report on a timely basis. And remember also that if your charity's income is over £25,000, you must, as part of the annual return, sign a declaration confirming that there are no serious incidents during the previous financial year that you should have reported, but were not. So in that situation, if incidents have occurred but they weren't reported at the time, you must submit these before filing the annual return so that you can make that declaration, which is a statutory requirement under the Charities Act. So if you don't report an incident that subsequently comes to light, the Charity Commission may consider this to be mismanagement, i.e. the trustees have failed to manage the risks properly and breached their legal duties, and this could prompt regulatory action. So closely linked to this topic is the issue of our responsibilities as auditors and independent examiners to report matters of material significance to the regulators, relating to things that we become aware of during the normal course of our work. In their broadest sense, these are not new requirements. However, the guidance issued in the past was limited to a short list of issues published by the Charity Commission and OSCA, which has very much resulted in diverse practice about what and when auditors and independent examiners did report. So in April 2017, after a consultation period, the regulators issued new requirements for auditors and independent examiners to follow. And this guidance aims to improve the reporting by both auditors and independent examiners by adding application material and examples. Arguably, this has also had the effect of raising the bar in terms of the responsibilities, particularly of independent examiners, and charities might want to ensure that the proposed independent examiner has the appropriate knowledge before appointing them. So the legal basis for reporting, i.e. the auditor's duty to report, is set out in the various bits of legislation on this slide, both for England and Wales, Scotland and Northern Ireland, and these have been in existence for many years. So the issues we're required to report on if we become aware of them are set out on the next few slides, and I just want to highlight a few points from them. It's also worth noting that when we talk about material significance, we're not using the word material to mean financial statement or audit materiality. Material in the context of this guidance is what would be considered to be material to the regulator in carrying out their function. And this is clearly an area where we need to apply judgment. But again, the philosophy of when in doubt, report applies in the same way as it does to the reporting of serious incidents by the charities themselves. So our consideration of matters of material significance includes dishonesty and fraud, failures of internal control and governance that did or could give rise to a loss of charitable funds, money laundering and criminal activity. It also includes support terrorism, risk to charities' beneficiaries and breaches of the charity's trust or a breach of law. And when we think about a potential breach of law, it might be interesting to think about this in the context of GDPR readiness next May. So if a charity is in breach of an order or a direction made by the regulator under statutory powers, such as a suspension of a trustee or prohibiting a certain transaction, we will also be required to report. And finally, we come to two new areas that we are now required to consider. Firstly, if we as auditors or independent examiners are giving any kind of modified or qualified opinion, including an emphasis of matter, then we are required to report that to the Charity Commission as a matter of material significance. And the second new area is around the reporting of conflicts of interest and where we find evidence that significant conflicts of interest have not been managed appropriately by the trustees or related party transactions have not been fully disclosed as required under the SORP or the regulations. So in this regard, we've been raising this issue with clients to ensure that they have robust procedures in place for identifying a potential conflict and related party transactions, starting very much with the induction process for trustees, flowing through procurement processes and the maintenance of the register of interest as well as the year-end declaration process. If you're only looking to pick up these things at the year-end, you might want to consider what additional steps you can be putting in place to ensure you don't get caught out. So as noted on this slide, the provisions also establish the right to report to the regulator something which is outside of these specific reportable matters, but which we believe is relevant to the regulator in carrying out its function. The right and the duty apply to both incorporated and unincorporated charities. To be clear, these requirements don't apply to the role of internal audit. However, the requirements are not restricted to UK activities, and therefore if expenditure is happening outside of the UK but it gives rise to a matter that we should be reporting, then that matter must be reported. And a few final points on this slide from our perspective in considering whether we might need to undertake more work and how the issue might be resolved collaboratively. However, although it may take some time to work through and resolve any issues that we identify, it is clear that we should not be waiting until there is a conclusion before making our report. And of course, the trustees themselves would need to consider the perception from the regulator if we have to report something that has not previously been reported by them as a serious incident, as this is likely to be seen in a rather dimmer light. So that just concludes my section. I just wanted to give you some heads up on some dates for your diary of events that we're holding. So coming up in mid-December, we are holding a membership conference here in conjunction with the law firm Russell Cook. So this is going to cover a wide number of areas that may be relevant to you if you have membership within your organisation. And moving into 2018, we have a SORP breakfast seminar, which is launching the new checklist that we produce in collaboration with civil society. And then moving into February, for those charities that have retail operations, we will be undertaking a review of charity retail in light of what's happening in the high street and the commercial retail trends. And a date to be confirmed yet in the spring is the launch of the Charity Administration Handbook that Don authors and edits in conjunction with Kate Kirtland. So look forward to seeing you in due course, and thank you very much.